Picture a savings account opened in the 1980s. A few $100s deposited after a bonus or a gift or just leftover cash someone meant to do something with later. Nothing dramatic happens to it. No one closes it. No one adds to it. It just sits there, collecting a small amount of interest every year, while the person who opened it goes on living their life somewhere else entirely. Maybe they moved. Maybe they changed banks for their everyday spending and simply forgot this one existed. Maybe they passed away and whoever handled their affairs never found the paperwork. However it happened, the account keeps existing in a ledger, technically active, practically invisible. Statements go out. Nobody opens them. Years pass this way. 5 years. 10. In some real cases, decades. And then one day, it disappears. Not stolen, not spent. It simply stops appearing on the bank's own books as the bank's problem to track. If you called that branch today and asked about it, they might not even have a record of it anymore. To a casual observer, that looks like money that vanished into thin air. Or worse, money the bank quietly kept for itself. That's almost exactly what most people assume happens to old dormant accounts, that the bank keeps it. Or that the government just absorbs it as free money, no different from a parking fine or a tax. It's a completely reasonable guess because the process is invisible by design and nobody ever explains it in plain language. It's also not what happens. In nearly every jurisdiction with modern financial regulation, that account does not get absorbed by anyone. It gets transferred by law to a government office that exists specifically to hold it, unspent, indefinitely, waiting for exactly one thing: for the rightful owner or their heirs to come and ask for it back. The system that makes this happen has a specific legal name, a specific set of timelines, and a specific chain of custody that most people have never once had explained to them from start to finish. It runs quietly under nearly every bank account, every forgotten stock certificate, every uncashed paycheck, every insurance payout nobody collected. It has existed in some form for over a century, precisely because letting banks keep dormant money used to be a real and serious problem. And here's the part that should make you sit up a little. Nobody has to have died, and nothing has to have gone wrong for you personally to have money sitting in one of these systems right now. A forgotten security deposit, an old brokerage account from a summer job, a refund check that got mailed to an address you left years ago. This episode is going to walk through exactly how that money moves, exactly who's allowed to touch it, exactly how long it can sit there, and exactly how you check for free in about 5 minutes, whether any of it has your name on it. Dormancy is the legal term for an account that has had no owner-initiated activity for a defined stretch of time. Owner-initiated matters a lot here. Interest the bank adds automatically doesn't count as activity. A statement mailed out doesn't count. What counts is you logging in, making a deposit, making a withdrawal, updating your contact information, or otherwise affirmatively touching the account. Without that, the clock starts running. How long that clock runs before an account is legally considered dormant depends on two things: the type of account and the jurisdiction. In most U.S. states, a standard checking or savings account is considered dormant after 3 to 5 years of inactivity. Some states use as little as 1 year for certain instruments. Uncashed checks and wages often trigger much faster, sometimes within a year. Stocks, dividends, and safe deposit box contents each carry their own separate timelines written into that state's specific unclaimed property statute. This isn't inconsistency for its own sake. Different financial instruments carry different levels of expected owner engagement. A checking account is something you're expected to touch constantly, so a long silence is meaningful. A long-term savings bond might reasonably go untouched for years by design. The law tries to match the dormancy window to realistic behavior for that specific product. which is why there's no single universal number. Once an account crosses into legal dormancy, the bank does not get to just decide what happens next. What kicks in is a process called escheatment, from an old legal term meaning property reverting to the state in the absence of a clear owner. In modern use, it has nothing to do with the state seizing your assets. It's closer to the opposite. It's a legally mandated custody transfer designed specifically to take dormant money out of private hands and put it somewhere permanent and accountable. Before any of that transfer can legally happen, the bank has obligations. Regulations typically require the institution to attempt to contact the account holder using the last known address or contact details on file, often more than once, over a defined notice period before the funds can be reported and remitted. This is a real compliance requirement with real penalties for skipping it. The bank is not supposed to be able to simply let an account go quiet and then keep it. If those contact attempts fail and the dormancy period fully elapses, the bank is legally required, not merely permitted, to report the account and transfer the funds to the relevant state or national unclaimed property division. This is the exact moment the account disappears from the bank's own active ledgers. It's also, critically, the moment the money stops being the bank's responsibility and becomes the government's, in a very specific legal sense, we're about to unpack. Here's the detail that surprises almost everyone. When that money lands in a state treasury's unclaimed property fund, it does not become government revenue. It's recorded as a liability, an amount the state owes to a specific person, even if that person's current whereabouts are unknown. It sits on the books as debt the state carries, not income the state has earned. That distinction is the entire backbone of why this system works the way it does. Practically, this means the state is acting as a custodian, not an owner. The money is held in trust. Most jurisdictions do not let it just sit as idle cash either. It's frequently invested into short-term, highly liquid government instruments while it waits, generating modest returns for the state's general operations. But the original principle owed to the rightful owner remains intact and claimable, structurally separate from the state's own budget. And this is the detail worth remembering above almost everything else in this video. In most jurisdictions, there's no statute of limitations on claiming this money back. 10 years, 30 years, sometimes longer. It typically doesn't expire. Heirs can claim funds that escated before they were even born once they can prove the family connection. The government is, by law, supposed to be an indefinite holding vault, not a one-way door. So let's directly name the misconception this whole video is built around correcting. The common assumption is that unclaimed money eventually just becomes the bank's or the government's permanently, like an abandoned house nobody claims. That's not how it's structured. Almost anywhere in the developed regulatory world, the entire legal architecture exists specifically to prevent that outcome, because it used to actually happen before escheatment law existed in its modern form. Before modern unclaimed property statutes matured through the 20th century, banks in some places really could and did simply retain long dormant balances as their own, quietly, with no meaningful obligation to look for the owner. Escheatment law was built specifically as a consumer protection to stop financial institutions from profiting off customer forgetfulness. The bureaucratic, slightly boring process you're watching explained right now exists because the alternative used to be a genuine problem. In the United States, each state runs its own unclaimed property program independently, though most participate in shared search tools. The National Association of Unclaimed Property Administrators maintains a site, commonly referenced as unclaimed.org, and a companion multi-state search tool known as Missing Money that let you search by name across participating states at once. Dormancy to escheatment timelines are set state by state, generally in that 1 to 5 year range depending on account type. The UK runs on a meaningfully different structure. Rather than one central escheatment sweep into a treasury, dormant account balances are typically routed through a dormant asset scheme, with reclaimed funds and processes regulated under the Financial Conduct Authority's framework. Customers can generally still reclaim their money at any point, but the mechanics of who holds it and how the search process works differ from the U.S. state-by-state model. Other countries run their own variations, some centralized nationally, some handled through specific bank consortiums, some with shorter or longer dormancy windows than either the U.S. or U.K. What's consistent across nearly all of them is the underlying principle. Dormant funds move into a regulated, traceable custodial system rather than simply being absorbed, and the rightful owner retains a legal path back to their money. So how much money are we actually talking about across a system like this? State Treasurer reports in the U.S. have, in aggregate, cited figures in the tens of billions of dollars currently sitting in unclaimed property funds nationwide at any given time. That number should be treated as an approximate moving figure, not a precise fixed sum. It changes constantly as money sheets in and gets claimed out, and different states report and total it differently. But even as a rough approximation, it tells you this is not a niche, rare occurrence. It's a large, ordinary, everyday feature of how modern banking works. So here's the actual mechanics of checking in case any of this applies to you or someone in your family. Step one is the name search. For U.S. residents, that generally means going to an official state treasurer unclaimed property site or a recognized multi-state search tool and entering your name, plus any previous names or addresses you've had, since the record was likely created under whatever name and address you used decades ago. Step two, if the match appears, is proof of identity and ownership. This typically means providing government identification, proof of your former address matching the record, and in the case of claiming on behalf of a deceased relative, documentation establishing you as a legal heir, such as a will, probate documentation, or next of kin paperwork depending on the state's specific requirements. Step three is processing time, which varies considerably. Straightforward claims with clean documentation can sometimes resolve in a matter of weeks. More complex claims, especially ones involving an estate or multiple potential heirs, can take considerably longer, sometimes many months, as the state verifies the claim thoroughly before releasing funds. And here's the single most important practical point in this entire video. The official government search and claim process through state treasurer sites or their national equivalents is entirely free. There's no legitimate fee to search your own name, and no legitimate government office charges a percentage to release money that is already legally yours. What does charge a fee is a separate industry of private asset recovery, or finder services. These are commercial operations that search the same public databases you could search yourself for free, and then contact people offering to help recover their money in exchange for a cut, sometimes 10%, sometimes considerably more. Some operate honestly within regulated limits, others are aggressive, pushy, or simply unnecessary, since the entire process they're charging for is something anyone can do themselves for free in about the same amount of time. The practical rule is simple. Official state and national databases never ask for payment to search or to release a legitimate claim, and they will never demand your information be routed exclusively through a third party. If you're ever contacted out of the blue by someone claiming you have unclaimed funds and asking for an upfront fee, that is your cue to go directly to the official state or national site yourself and check independently rather than through them. Stepping back, the entire reason this quietly enormous bureaucratic system exists is consumer protection, plain and simple. It exists so that a bank cannot simply benefit from your forgetfulness. It exists so that decades from now, a grandchild who never even knew a certain relative had an old account can still, in theory, trace it and claim it. It's not thrilling. It's not a heist. Nobody did anything wrong here. It's just an unusually well-designed, if invisible, piece of financial plumbing. So here's the actual practical thing worth doing after watching this. Take 2 minutes, go to your state's official unclaimed property site or the the National Multi-State Search Tool, and type in your own name and maybe a parent's or grandparent's name too. Most people find nothing. Some people find a small forgotten balance. Occasionally, someone finds something that matters. Either way, it costs nothing, and now you actually understand what you're looking at when you do it. Somewhere in a filing system right now, there's a ledger entry with your family's name on it, or there isn't. The only way to know for certain is to look. And unlike almost everything else that disappears quietly into a bureaucracy, this is one system that was built on purpose to eventually give it back.